we've done a lot of background into the sponsors and into the syndicates. Um, and to be very frank, uh, most of the people, most of these sponsors are not qualified to be sponsors. We have found, on many of the occasions, these sponsors have basically teamed up with financial gurus on YouTube. They are themselves financial gurus on YouTube, and their backgrounds do not consist of any sort of financial, experience, let alone a university degree. They were, restaurateurs or chefs in the past, and suddenly they're managing $200 million in investor capital, and that is a red flag. And you're presented with an idea from real estate gurus or from the internet, this is a best way to make money. That is objectively false.
Hi, Adam Gower here. And before we get started with today's episode of the Real Estate Reality Show, I want to make sure that we're on the same page. So I'm going to provide you with some requisite disclaimers. Today's conversation is not a recommendation or offer by Gower Crowd to buy or sell securities of any kind. Information discussed today may include forward-looking statements and is for informational purposes only. Forward-looking statements, hypothetical information or calculations, financial estimates, and targeted returns are inherently uncertain. Past performance is never indicative of future performance, and none of the opinions expressed by my guest today are the opinions of me or of Gower Crowd. With that said, let's get started. Hi, Adam Gower here, founder of GowerCrowd.com and host of the Real Estate Reality Show at youtube.com/Gower Crowd. Welcome to today's episode. My guest today is Gabe Bernard, co-founder at Viceroy Research. The reason that I wrote to Gabe and invited him to join me today was because he wrote a report called Slum. Hang on a minute. Oh, I've got to click the CYA here. It's called Slumlord Millionaires, and it covers a fairly well-known, you're going to discover who joined the show, fairly well-known bridge lender here in the United States who has been doing a lot of lending to multifamily sponsors and whose portfolio appears to be struggling. Not that everybody's or nobody's isn't, if I can use a double negative. Anyway, I've been researching CLOs ever since I spoke to James Eng of Old Capital for the podcast a few weeks ago there in Texas, who's made $2 billion of loans, or not made them, but has put together $2 billion of loans. Just his one shop alone there, and just in Texas, of which he told me 90% was underwater. Then I spoke to Dan McNamara at Popo Capital, who is famous for having shorted mulls and just wasn't able to make any headway there either. He told me, no, you can't short CLOs. Well, Gabe Bernard at Viceroy Research is doing just that. You're going to learn a lot about what he is doing, how he's been doing it, what he sees, and why he thinks there is a very significant likelihood that multifamily real estate assets are going to hit rock bottom in the next few months. If you want to know more about Gabe, and in fact, if you would like to access his report, as well as gain access to the spreadsheets that he shares, go to GowerCrowd.com, go to the podcast page, find the podcast with Gabe, and all of those links will be there, as well as a big red subscribe button on that page that I would love you to click, if you would please, if you've not done so before, and sign up to receive our weekly newsletter. It covers the world of commercial real estate, has always had some educational content. You can always unsubscribe, and these days I've actually been putting a little funny cartoon at the bottom just to lighten things up. So that's all there at GowerCrowd.com. Hit the subscribe button, and while you're there, check out the page on my guest today, Gabe Bernard, who is co-founder, research, as he likes to say, extraordinaire at Viceroy Research. You are in for a treat today. Here he is. Gabe, I've been so looking forward to talking to you.
Having the Adam
about this article that you wrote over here, Slumlord Millionaires. We'll find out more about that in a minute. But before we get too deep into this, Viceroy Research, what do you guys do?
Well, Viceroy Research is above all else, an investigations group. We've been quite prolific in finding market opportunities, especially on the short side. And, our specialty really is identifying fraud, identifying, mistimings in the market, identifying opportunities like fads, and just finding, generally bad businesses. That's not to say we don't also dabble in what we think are very overpriced businesses or overhyped businesses.
Right. And in fact, in our email correspondence back and forth, you asked me, shall I talk about this and about that and this, that, and the other? Let's stay strictly focused today on US commercial real estate. So you mentioned there very casually the short side. So just explain that to the one person that doesn't know what the short side means exactly.
So we look to, our investments are basically short sales. We look to profit on the decline of company share prices, essentially. We'll bet against companies we think are overvalued.
And how do you do that? You buy, so how does that work? What do you buy?
Well,
you buy,
it's the same as borrowing money from a bank. You borrow money from the bank, you pay interest, and you return the dollar value of the money. Think about it as, instead of borrowing the dollar value of money, you're borrowing a certain number of shares. We'll borrow a certain number of shares from a shareholder. And then if the share price goes down, we'll return those shares and they're worth less. So if we had sold them in between, that's how we make the money. We make the money on the delta.
So the only way that you can make money shorting is if there is a public market. There has to be somebody on the other side that you can. So what are you doing? You're buying the share? No, what are you doing?
We'll borrow the shares,
borrowing the shares, right?
And then we'll sell them, and then we'll have to return that number of shares back. So we'll buy them on the public market. If the price has decreased, we've made money.
So there has to be somebody. So it's public. They have to be publicly and
these are all public markets,
right? So let's just jump straight into it. This article that you wrote, Arbor Realty's Trust, Slumlord Millionaires. So what's this article about? And to kind of start at the very top, what made you want to research this? Like, where does it all come from?
Well, this sort of came to us, maybe a couple of years ago. I think there's been a lot of attention in the multifamily real estate market from short sellers' perspective, because it has been so prolifically touted as, this free money making scheme, right? And when something sounds too good to be true, in our book, it usually is. And that's not one of the lessons that the real estate gurus will ever teach you at these, Tony Robbins-esque communities that will pop up all over YouTube, all over financial Twitter, or over TikTok, that encourage people to spend $5,000 to come to a class to learn about multifamily real estate investment. And I think a lot of the money web that has stemmed into this asset class specifically, multifamily real estate, has come from unsophisticated investors. We've seen, especially, if we narrow down into Arbor, we can get into that as the podcast goes on, but there's been a general sense that the government basically wants you to buy and rehabilitate multifamily residential units. There is a lot of government agency loans available for rehabilitated units, and at a 0%, cash rate for a long period of time, it was very difficult to lose money buying a unit or buying units, rehabilitating them, increasing the rent, and then getting an agency loan for 30 years and basically repeating that system. What I think the problem with this scheme was, or with this investment strategy, is that if we ever experienced an uplift in interest rates, as we did during the GFC, even the most blue sky investment in multifamily real estate would not be profitable. And we've kind of held out for that to be the case in publishing this report and doing this research. And now that we have enough access to the background data and to the data of the underlying assets that support all of these loans in the multifamily real estate bridging market, we can pretty conclusively show that they're all underwater. And when I say they're underwater, we can show that the net income that's flowing in to the purchases of these real estate assets is less than the interest they're paying to the banks on a floating interest base.
Gabe, we got to step back a little bit. So that there are a lot of sponsors, right? So these, and I think these are the ones that you have termed investors. So we got to be clear that there are two different types of investor. So let's use these terms, if you don't mind, just for clarification. Sure. There are passive investors. So those are in the States, typically they're accredited investors, high net worth individuals who have day jobs, and they invest small amounts of money into deals that are run by, let's call them sponsors. Right, so the sponsors
run the syndicates.
They're the ones they are the syndicators, exactly. Sure. Right, so they're professional real estate investors, but if we call them sponsors, it just helps.
Sometimes.
What's that?
Sometimes.
Well, hang on. So let's just step up. So there's this. Well, talk about this community of sponsors then. Let's start there, and then let's talk about what these bridge loans were and how shops like Arbor fit into the picture. So who are these sponsors and what's their business?
So we've done a lot of background into the sponsors and into the syndicates. And to be very frank, most of these sponsors are not qualified to be sponsors. We have found, on many of the occasions, these sponsors have basically teamed up with financial gurus on YouTube. They are themselves financial gurus on YouTube, and their backgrounds do not consist of any sort of financial experience, let alone a university degree. They were, restaurateurs or chefs in the past, and suddenly they're managing $200 million in investor capital, and that is a red flag for us. And I have no doubt that there are sponsors who mean well and who are, who legitimately think that this is a good course or good trajectory for their business. But if you're unprepared for these hiccups in the market, and you're presented with an idea from real estate gurus or from the internet that this is a best way to make money, that is objectively false. We are in a situation right now where it's not easy to make money, and they're not prepared for it. And we can show that objectively they're not prepared for it, because we know that these investments are not making money. And these sponsors have syndicates which are vastly underwater. And really, if you're in a syndicate to purchase an investment property, there's not really that much equity that you can plug in to fill these gaps. Right? If your interest is eating into your equity, you're not making the rehabilitation necessary for the unit to flip it, and the implied cap rate or the yield from your investment is less than the risk-free rate of the US bonds, then this investment is underwater.
Yes. So how have you done your research? Right. So we've also conducted research, but completely different, from a different perspective, right? Coming at it from what we did was we conducted research on how big has this syndication industry grown. That's what we did, and we saw it's grown massively.
And it's quite large. Yeah, exactly right. So the syndicates do make up a lot of the of, let's say, the AUM of Arbor, which is what we're looking at specifically. Arbor, its role in this strategy of buying and selling multifamily residential units is that it provides bridge loans.
Okay, what are bridge loans?
So the bridge loans are basically a bridge between purchasing the asset, rehabilitating the asset, stabilizing the asset, and then refinancing this asset as a government agency loan. So the way, so they're floating rate for starters. They're medium-term loans. They'll be 18 to 24 months, and a lot of them include or are based on a loan to cost value, which includes the rehabilitation costs of these properties. The intention when you buy one of these properties is, and I'm speaking generally, this is the strategy of doing this. You will buy a property at a cheap price that needs some work done. I won't say that they're decrepit, but they're pretty close. The intention is that it's in an area that you could uplift rent quite easily if the works have been done. Your intention is to invest some capital expenditure to rehabilitate these properties. So fix roofing, make them look nicer generally, maybe put in some better appliances, and then increase the rent. And then by doing so, you've increased the yield, and this property is theoretically worth more on a multiple of its cash flow. And then once that's rehabilitated, you basically meet you meet the criteria. You used to have meet the criteria to put this into an agency loan with the government that are pretty cheap. They're sometimes fixed, sometimes they're not. But if they're not, you still need a rate cap for the period of your loan. And then you repeat, right? You've cashed out, you've made some money, you go back and you do it again. So that is Arbor's role in the business. They are the bridging loan that stays in between. So their 15 billion-ish loan book is entirely made up of bridge loans. I think it's 90% made up of bridge loans. So their exposure is effectively in this industry almost exclusively to floating rate loans of very risky investments. And the majority of them were made at almost 0% cash rates. And now that we have
cash rate, you've used that term before. You mean interest rates, right?
Well, interest rates for them would be different, but we're talking about the risk-free rate. So the government bond rate, let's say. So we've these investments were made when government bonds were trading at like 0.25% rates. They're now at 4.6-ish. Well, they were when I wrote this report, so I'll go 4.6. And the yield on government bonds is greater than the yields that they're receiving, that the investors or the sponsors are receiving on the underlying properties. So it begs the question, obviously if no one knew that the rates would have jumped this high, but it doesn't make any sense to now invest in multifamily residential units when you could buy a 10-year treasury bond and make more money.
Right. And so the value of these properties have gone down.
Well, this was the contentious issue. And this is where we've got most of the criticism from our report, is that when we say, okay, look, these are underwater, what's the recovery value? There's obviously a collateral value of these underlying assets, which is the properties and the equity in the property. But the equity in the property and these properties were valued at a implied cap rate of between 2.5% and 6%, but on average about 4.5%. And to say that the value of the cash flow of multifamily residential investment is the same as the US Treasury rate is absurd, right? These are inherently risky. Most of them haven't been rehabilitated because interest rates are so high. And we've gone through individually in our report the reviews of these properties. They need work done still. These interest rates went up, and it basically kneecapped their ability to rehabilitate these properties. You have to eat into your equity just to pay your interest. So we are in a precarious position where the transaction volume for these properties, as in the market transaction volume, is down significantly because no one wants to admit that these properties are underwater. So we're now in a stalemate where all of these companies that provide bridge financing to all of these properties and all of these syndicators are in a state of denial that their properties are underwater. They can't afford to pay interest rates. These loans have to be essentially refinanced within the next 13 to 18 months. And they don't really meet the eligibility for any refinancing anywhere, not even at Arbor. So
Okay.
yes, we probably will see the market prices go down on these properties. That's what we've bet on. But to say that we have a price discovery at the moment, I think is difficult because we have no transactions at the moment.
Okay, got it. Right. So, but there is, there's a lot of data out there that is pointing to significant cap rate expansion. So even if there isn't, if there's the bid ask spread
Yes.
in the market and there's no transaction, it's because sellers either cannot or don't want to
Yes.
sell, and buyers won't buy at the prices that sellers want to sell. But everybody knows where the pricing is. Tell me a little bit more about the CLOs and what a CLO is. So what you've described so far is an army of, and I'm going to quote from the report, naive sponsors. You actually say naive investors, but naive sponsors. And you've got a bridge lender who has been lending to individual projects and to individual sponsors at varying degrees depending on who the sponsor is.
Yeah.
What is a CLO and how does that work? Because that was also at the core of your report, wasn't it?
I mean, fundamentally, the CLO is basically debt for Arbor, right? They make these loans out to sponsors. That cash is then tied up. But it's an asset on their balance sheet, this big receivable loan. So I guess the easiest way to think of it is, well, Arbor wants to make more of these loans. It can leverage up its book by selling some of these assets, let's say, to a CLO. And the CLO basically solicits investment from, basically credit funds, I would say. I think it's mostly JP Morgan, investment banks, largely.
And a CLO is a collateralized
loan
obligation. Right.
Correct. So basically, they will sell individual loans into the CLO, which is a trust, and then in return, they have more liquidity to spend on making more loans or underwriting more loans. So the CLO basically acts as a debt instrument for Arbor.
So the individual loans are, you said, sold into, but put into a CLO.
Yes.
And that CLO then attracts investors based on various tranches within it.
Sure, right. and exactly right. There are the tranches of the investors. I mean, we have senior bondholders in this Arbor CLOs, and Arbor retains what's called the residual or equity tranche. It means that in a waterfall, in a scenario where you do have delinquencies, basically Arbor is not paid until the senior members of the senior tranches are paid, which is the senior bondholders and secure bondholders. And we detail in our report that, firstly, the CLO has its own basically cash flow triggers, which trigger essentially a caveat in the CLO, which means that Arbor is not paid.
Trigger a what, Gabe?
Trigger basically a caveat.
A caveat?
Yes.
What does that mean exactly in this case?
Well, in this case, the interest coverage ratio has a limit of 1.2x. And the interest coverage ratio is not of the individual properties, but of the net income of the CLO, which is to say the interest that the sponsors will pay against the amount due to the senior bondholders. Right? So we have to have... well, the average over the if you refer to page 12 of my report, if you have it there in front of you,
I am actually on page 12 by funny.
There you go. So at the bottom there's a table that we've copied from Figure 21 from Arbor's reports.
Mm-hmm.
So you can see that the interest coverage over time, the limit is 1.2x, 120%. Over the last sort of 3 or 4 years, this has been an easy pass And towards now, we are scraping the covenants that the CLO has to operate in. So a lot of the times you'll see, and because we track these vintages month by month, like we track what is in the CLO month by month, Alba has the ability to buy loans and sell loans in and out of the caveat.
Yes.
What we're actually seeing is we think Alba has to buy loans out of the covenant and replace them with better performing loans so as not to breach these covenants.
Well, isn't that the point, though, of a CLO?
That is
That's why people invest in them. Let me just hold this thought, because again, I was total discovery for me. But isn't that the point of the CLO and how it differs from CMBS, where you have special services, and once something goes into a CMBS, it's there kind of irrevocably. But a CLO, in this case, I'm not sure if you call Arbor the sponsor in this case, but let's call them the sponsor in this case, or the lender, the bridge lender in this case. So they create a CLO. And they have the ability for any assets that are subperforming, they can swap them out. So doesn't that give them an enormous amount of control over the health of the CLO?
Yes, it does. And to basically say that, yes, they have enormous control over the health of the CLO, and to also concurrently show that the CLO is scraping past its cash flow triggers, is to say that, well, firstly, we think that the CLO is very representative of Arbor's entire book. And this is not the only test we've done. We've gone through Arbor's, we can tell by Arbor's book and the length of its loans and the average interest rate. Let's say the interest rate of its loans represent the risk of its loans. That the Arbor's own book of CLOs, which is another 7 billion-ish, is roughly the same as its CLO book, which is about 7.5 billion-ish.
Let me try and say what I think you just said again. I'm going to try and paraphrase. Are you saying then that the entire Arbor portfolio in this case, and there are others, it's not just Arbor, this is just because you've written this report, but that the entire portfolio is underwater, and that even though they have the right to swap loans out, they don't have anything to swap out because they're all just as bad?
That is our belief, yes.
Interesting.
And the reason, I guess, if we circle back, the reason why we believe Arbor is a good short is because, let's say hypothetically, we start seeing defaults and we start seeing delinquencies in these underlying assets, right? In these loans. In a waterfall situation, the senior bondholders of these CLOs are probably in a good spot, right? They have a 23% equity buffer in the LTV of the properties. So even if they take a 23% hit, they're still okay. Everyone's still okay. And then the next hit will be absorbed by Arbor, who has the residual tranche, right? Or the junior tranche in the CLO. That's great for the senior bondholders in these CLOs, who are probably going to walk out of this pretty much unscathed. But for Arbor, who has, and we've gone through this, the implied cap rate of the assets we can see in the CLOs roughly 4.5%, which is the same as the US Treasury rate. If you were to go
what do you think cap rates are then? What are the realistic cap rates? I mean, that's really the crux of your case here.
We can find much healthier assets in other asset classes that are 8 or 9%. So I think 6 or 7 is a very safe and optimistic assumption of, in an environment where this entire industry has underwater bridge financing, and these properties have to go to market because they're not refinanceable. I think 7% is very optimistic.
Well, even if it's 6%, Gabe, that from a 4.5%, it's 30%, 33% decline in value.
Look, if it's 7%, the Arbor's entire equity tranche is worth 0. If it's 6%, it's probably half. And because Arbor absorbs the grunt of this, this disaster, right? because it has the junior and most at-risk tranche of these CLOs, it's the first one to take the hit for the majority of its book. So as far as a short case is concerned, this was probably the best pick for us because of how much exposure it actually has, ahead of other senior lenders, and how poorly disclosed that is in his books.
Okay, so we've been working with sponsors again. Although this report is about Arbor, and I'd like to ask you a little later why exactly, or how you came to Arbor specifically, and what others you might be looking at as well right now, because it is industry wide, this issue. So what we are seeing with sponsors is that while interest rates have gone up as much as they have, and cap rates have climbed, and the market has basically frozen up, there is a general consensus that if you can make it through the next 12 to 18 months, you'll be okay. And so a lot of sponsors are going out doing capital calls. They're raising capital from investors in order to buy rate caps. Plus, there's another extend rate caps so that they can survive another year or two. And then the other aspect that we're seeing is that a lot of lenders like Arbor and others, right? So it's not just them. In general, what we're seeing, and in fact, the government is encouraging banks to do and lenders to do, both on the regulated and then in this case, not regulated, but the high street banks versus the bridge lenders, the private lenders, is to extend, is to work with borrowers to extend, almost as though they are anticipating a reversal of the markets, a Fed pivot, lower interest rates, higher prices, and if you can make it through, you'll be okay. So what are your thoughts about that? That is factually what we are seeing in the market.
No, that's and this is actually great, because I'd love to get some of information from you now. maybe I should run the interview. Well, look, firstly, crystal balling for a market turnaround in 18 months. I think
you can't do it. No, of course not.
Do it, right? You have to live in the moment. We're seeing 10-year yields for Treasury bonds at 4.5%. This does not look like the market's anticipating a significant enough rate adjustment in 18 months to actually make these viable again. You can have a 150 basis point swing, and these are still underwater, realistically, right? So I think that is a lie that the sponsors are feeding to their investors to throw more capital at this, because as you said, the idea is to hold on for another 18 months and things will work themselves out. There's no more equity behind these deals, right? They are leveraged to the essentially the limit.
Yeah, look, Gabe, look, equity has been wiped out. There's a general acknowledgement it's been wiped out.
And therefore, what is available to you as a sponsor is to go back to your investor base and ask for more money. Correct. And that's not fair. Well, firstly, it's not fair. And secondly, I don't think that a lot of these investors have that much more money to give. No one's going to go out and pitch more cash at a maybe in 18 months we'll get cash out of it situation. You could buy treasury bonds. So look, I think for us that option is not crossed our mind as being problematic for our short position. If you were to then say, okay, well, let's work with the lenders to extend these facilities indefinitely. Right, with rate caps. Rate caps is an interesting one because it seems like there's a total sort of, it's bizarre the way that investors have worked to obtain these. You would think that you would buy rate caps at a zero rate environment, right, when interest rates were very low, and you would hold on to them for a long time. What we actually see is that no one had bought them when it was 0%, and everyone wants them now when it's 5%.
Well, they were bought, and actually they were, but they were very
they were bought. They were
10, 20,000 for whatever, however many tens of millions that you were buying. But it was only for a year, and now those are expiring. And now the cost has gone from 10,000 to 1 million and 2 million and whatever huge.
Exactly. So, and then, so I think the main question was, and we did speak to some rate cap brokers, is, well, the consensus we found was that that's just not generally viable either. I mean, if you're paying for your rate caps instead of paying the interest at this market, you're almost worse off, if not the same, than just paying the interest for the next
so
couple of
we've
years.
yes, we've also looked at that. So look, this is very interesting that you're talking about it in these terms. I hadn't expected to kind of get into this because look, your perspective, whether it's Arbor or whether it's the market in general, is that there is very considerable imbalance or disconnect between the amount of debt out there and what assets are actually worth. Correct. And therefore, there's somewhere, how do you make money? Like Michael Burry, right? During The Big Short, right? Basically.
Yeah.
With exactly residential real estate, you're out there looking for opportunities and look, it makes absolute sense to him. He became very famous because of that.
Yes.
But so to what extent do you consider, or how have you considered the possibility that borrowers, sponsors, and lenders both recognizing they're both kind of in this together, right? That they could both go, but they could both collapse, find ways to extend, not and pretend, maybe it is pretending, we'll only know at the end of the game, but to extend just long enough to see what actually does happen.
Well, this is we pointed this out in our report as well. Like, we don't think that this entire industry is dead because of this bad judgment of timing, whether it be timing or preparation for interest rate rise. But I think that either this market will present a great opportunity for vulture funds or distressed debt funds, because realistically, the ones that will likely have to pull them out of Arbor and other bridge loaners to free up financing, that Arbor has commitments to its own lenders. It doesn't just have a commitment to its shareholders, and therefore it can openly extend loans with lower interest rates to help these sponsors out. It has its own obligations. I think realistically, the way to sell them would be to sell them to distressed debt funds, vulture capital investors, who have the capacity to sort of wait it out, right? I think that's a reasonably fair game plan, but I don't think that Arbor itself has the capacity to do that, and Arbor itself would still need to take a hit somewhere on the way to extending these loans.
So here's another question. So you've talked about, because I'm really interested. How did you stumble across this? I mean, you guys look at the entire world.
Yeah.
This email you sent me, shall we talk about this and that and the other? But no. It's like just US commercial real estate. So obviously you look at stuff all over the world in all kinds of asset classes. How did you stumble across this, and how did you do your research in the first place to uncover what you've described of as, I'm going to paraphrase, naive sponsors? How did that all, tell me the story of how you got there in the first place.
So, I mean, we've been focusing on real estate shorts for about 2.5, 3 years now. And it's mostly come out of that meme stock period where, during this COVID lockdowns, everyone would start investing in these absolutely absurd companies that turned out to be massive frauds. Mm-hmm. But for us to write that they were massive frauds didn't actually dissuade anyone from keeping investing in them. So we thought, hey, what's the boringest industry in the world where we're not going to run into your average Joe Reddit, Wall Street bets guy who's going to disregard our investment thesis, not read any of our work, and continue buying out these crappy frauds and losing us money. And we thought that's real estate.
Right.
So, and not only real estate, German real estate, right. So we've been writing about German real estate companies. We've been working on Swedish real estate companies, UK real estate companies, and it's just kind of gone and done the rounds. And obviously, we get hundreds of emails of, we should look at this, we should look at this. But Arbor seemed to, we looked into Arbor, again, someone else had written a report on Arbor before us. Totally, different theses, very little repetition of what we wrote about. But it seemed to us that someone raised the point that, look, the information from the CLOs You can get it publicly available. It's on a system called.
But a lot of what I was noticing there, a lot of the DSCRs, debt service coverage ratios, were below 1. In other words, there wasn't enough cash flow to service the debt, and in many
Correct.
cases, substantially below 1.
Yes.
Yeah.
And
So,
and
all
those
right.
and those figures and the figures. I'll just point out as well. We have a summary of the debt service coverage ratio of the individual, almost tranches of the CLO on our report. Those figures are inflated upwards because in a lot of cases, we're not provided. Well, some loans don't actually have the net income provided to the data operator or the value of the properties, let's say. So these are skewed to an extent, but once we kind of tidy up all this table and remove all of the outliers in the sense of we have no information on certain of these loans, in this residual shortfall analysis here, this is the debt service coverage ratio of all the properties with full information, which is 0.63. So that's the weighted average for the portfolio. That's very low.
That's one portfolio, and this particular one had 300 and something loans in it.
This is for the 300 loan one.
Yeah, that one that we were just looking at, 300 and something loans.
Yeah.
And typically, how big are CLOs in dollar? Like going it like face value dollar.
I mean, the other one is about 7.5 billion to 8 billion.
That's not a single CLO, though, is it?
No. So the single CLOs here we have,
because this one page that I'm looking at in the report has CLO 12, 13, 14, 15, 16, 17. In other words,
correct.
Dozens of CLOs.
Anything between sort of 600 million to 2 billion.
Okay.
Yeah.
All right. So look, Gabe, before we so let's wrap up. I would love to go through this whole thing with you in detail. But obviously your business is premised, you make money premised on a downturn and on a company's faltering. So you're betting against this company and presumably others, excuse me, that you've got in your sights. Here in the States, it's not just Arbor that have been making bridge loans. There are plenty of companies that have been doing that. So what realistically, where do you think the market is going to go? There's a lot of talk at the moment of the Fed pivoting, that they have stopped increasing. They will pivot. There's an anticipation that there'll be a pivot before the election, right? The market, as soon as that happens, you and I both know that all the money sitting on the sidelines is just going to flood in. That's going to prop everything up. There'll be an election, and who knows, where are we going to go? What of that? Where realistically, based on your research and experience, where do you think the market's headed, and what is the timing for you to make money? When does it have to happen?
Well, this portfolio again, I think the average loan length is on the portfolio at the moment is 13 months. Realistically, we don't see these syndicates, the sponsors, or regular investors being able to meet any sort of equity shortfalls and large interest rates for that period of time. And even if we have a huge downswing in interest rates, if we're talking 150 basis points, which I think is otherworldly, I don't think it will happen that quickly. This portfolio is still underwater. So realistically, it will have to come out it will come out in the papers, it will come out in the cash flow. Eventually someone's is going to become delinquent. They're not going to be able to keep paying interest rates. We're seeing that more and more now. We can track this TREP data month on month. We know that there are more delinquencies happening month on month. This is tracking exactly how we expected it to track. We know that Arbor's own book has allocated more assets in its book to delinquent, more assets to impaired, has been making impairments on assets at a steep rate. It had no impairments, 0 at the start of the year, and now has $100 million worth of impaired assets. So this is on track to, I think, be a disaster. But at the moment, people are at this, we're going to hold off stage. But realistically, we're going into a period of about a month, maybe a month and a half, where we're going to have very, very little transaction volume because it's Christmas. We're going to have very little market activity on the financial markets, as in the shares. And I would not want to be holding this over that time.
And industry overall, you're looking at other similar entities here in the US and doing research on others?
Look, we have others that we've looked at in the same space. I think that they're equally bad. I think Arbor is probably within them the best short, at least that was our thought. We have, you know, the tricky part is I think once one of these collapses, they will all collapse. So I think that will, again, this will all play itself out. But we have no immediate intention of writing about anything else at the moment. I'm going to enjoy my Christmas and my holidays here.
Gabe Bernard, is that how I pronounce your last name? You did tell me right, and I immediately forgot. Gabe Bernard, co-founder, researcher extraordinaire at Viceroy Research. Thank you for joining me on the podcast today. All right, that was Gabe Bernard, co-founder at Viceroy Research, talking about his research into CLOs and where he thinks opportunity lies. Everybody's looking for opportunity in the decline in the market, either by buying distressed assets or by shorting stock, whatever it is. There's opportunity knocks in this market. And anyway, I hope you thought it was as interesting as I did. I found Gabe very interesting. His report is definitely worth reading. And of course, nothing at all that was said today should be taken as investment advice. You know that already. But do please seek advice from your professional financial advisor or accountant, whoever you go to for your financial advice. Today's show was strictly educational. And I hope you found it that way. Gabe, thanks so much for joining me. I am looking forward to talking to you again next week off the record and learning a bit more about what you do and what you're seeing in the market. And thank you also, dear viewers, for joining me today. I hope you found today's episode as interesting as I did. And that's all I've got this week. So thanks for joining me. For now, I'll see you next time. And for now, this is Adam Gower signing off.